Okay, Facebook, good morning. Hope you are well. Let's look at a question that we got sent in to us. This is a really interesting one. So I got asked, or we got asked, what technical tools beat the market? So really interesting question, because actually what this does is this throws up about 3 or 4 different things that we can look at here. So number one, if you've been around me or you've been around Trader Support Club for a while, you'll know what my answer to this question will be straight away, which is there is no one technical tool that beats the market. There isn't an indicator, there isn't even an individual concept that beats the market. It's not the widget, it's not the tool, it's not the the level, it's not any of that. So it's not Fibonacci, it's not MACD, it's not moving averages. There is not one technical tool that beats the market. And I think we're going to look at this from this angle first, which is why do traders and why do so many traders either ask a question like that or look for a specific technical tool that beats the market? And I think the reason is in a lot of cases trading attracts the type of mindset. It's almost like I call it a widget mentality, where people are looking for something specific that they can plug in and use. And if you think about our current culture, an app, a plug-in, a thing, a widget that they can use to make their life more efficient. And I think that comes across and that moves across into trading. If I can just find the one indicator, the one tool, the one concept, then I can beat the market. Well, a trader that is beating the market, and we're going to explore the whole concept of beating the market in a second. A trader who's beating the market is not doing it because they're using one indicator, and there isn't one indicator that is better to beat the market. So I may have a technical process that uses, say, support and resistance lines, moving averages, and divergence. Okay, that's primarily the 3 concepts I use. And at some point during that process, I'm beating the market. And overall, if you look at it over the long term, I beat the market. But my trading process is so much more than, very simply, the levels, the indicator, the moving average, and the MACD indicator. It's the years of experience I've got at picking the levels. It's going through and managing the losing periods. It's knowing when to go into a trade at half stake or full stake. It's managing my risk correctly. It's the mindset I have, and it's all the subconscious or unconscious experience that I bring to that. So it's not the tool itself. So I think, firstly, that's the key thing. Traders need to realize that there isn't one tool that beats the market, and there isn't really a combination of tools. There isn't some holy grail of this widget with this process. There are lots of different ways to beat the market. But I think the traders that are asking that, you need to look at your psychology, because if you come into it thinking that way, rather than thinking, how can I learn a process and refine that process and find my own way to beat the market, then what's going to happen is you're going to come and speak to me and then disappear off to another education company and then go with the education company that promises you the widget that works, and then you realize it doesn't work. Well, it might be that that widget was quite efficient at doing what it needed to do, but you couldn't necessarily stick to that particular process. It might be that the process that they have has a widget that, or a process and a methodology that means you have periods of losing trades. So I often hear traders saying, oh, this particular strategy doesn't work, or this particular widget or this particular process doesn't work. I hear it doesn't work all the time. Yet actually, there's so many other variables that could mean it doesn't actually work for them. And we see this in our trading room. We see 2 traders trading a similar process, similar strategy, that can see a market differently or even end up with a different result at the end of it. So that, I think, needs deeper examination if you are asking that question. And you really need to get around people that are going to question that mindset and that concept. Okay. So I think another one to think about here is this idea, and we'll look at this a bit more deeper in terms of beating the market. Okay, because beating the market has 2 key things to consider. Now, let's say I have a strategy. If you look at our Beat the Bank strategy, the reason it's called a Beat the Bank strategy or Beat the Bank's program is because over a 20-year period, the return that you get each year beats the return that you get in the banks, okay? But here's the really important bit, that over that 20 years, that's an average. There were a couple of years during that 20-year period where you lost money. So if you were comparing the beat the bank strategy on a certain year, you may not beat the banks because on that particular year you had a losing year. But the following year you had a 23% return. So over those 2 years you've outperformed and outstripped any return you'll get in the banks. So if we relate that to the market, it's the same thing. If the market is up, let's say an average, the S&P is usually up, I think 10% average year on year. Okay, so let's say the S&P is hitting a 10% average in a period of a year, and your trading at that point over that period of that year makes an 8% return. You haven't necessarily had as good a year as planned, but the next year the S&P comes in at say 12, so it outperforms its average, but you come in at 52. So your particular process and strategy over those 2 years as an average is beaten the market. So very often a trader can be actually sitting on a strategy or a process that does over time beat the market, but because they're thinking too short term, the challenge is they go, this one doesn't work, or I need to change this or need to change that. So this is something that's really important, is you have to define what beating the market means, and it's not just simply looking at it in that moment, in that quarter, in that 6 month period and saying I'm above the market or I'm below the market, because very often the market can have a rally and then change. So what is it? I think a better question to ask is, what do you want to achieve from a return from your trading, and then look to see if there are strategies and processes that have the capacity to do that. And this is something we do with all of our students that go through any of our programs. One of the first questions I ask them is, what do you want? And very often all they say is they want to make more money. Well, everybody wants to beat the market, everybody wants to make more money, but what do you specifically want? And then does the strategy that you're going to trade, or does the methodology that you're going to employ at least have the capacity to do that? So finally, how do we go about beating the markets? What things do you need in place? Well, the first one is mindset. So the key thing is you've got to look at your mindset in two ways. And I was actually on a podcast on Monday, it was on the Desire to Trade podcast, and I was talking about this exact specific thing. Because essentially there are two mindsets that work either for a trader or against a trader. And I think the first area is what's called a trader's mindset. So it's understanding the specifics of random distribution, coping with extremes of losing runs, extremes of winning runs, dealing with loss, managing risk, not reacting to the result of a previous trade. Okay, so that's very specifically a trader's mindset. And those of you that come to any of our programs, you know we spend a lot of time working on that. But then next to that is also, I call a money mindset or a wealth mindset. And this is generally how people approach money, what are their beliefs about money. So I can work with somebody that understands intellectually what they need to do around their trading mindset. They know that they need to manage their risk in a certain way. They know they need to not react when they're winning or losing or going through a period of drawdown. But then what's interesting is their beliefs around money mean that they shift. So they may, as a result of having a negative association towards money, they'll start saying, this doesn't work, I can't do this. All sorts of weird and wonderful things come out. So the two, trading mindset and a wealth mindset, actually interact with each other. And it's very, very important as a trader, I think, to examine not just the technical specifics of how you should think in terms of a trader, but also examine your beliefs around money. What happens if you have a belief that money comes hard? You've got to work hard for money. Could that impact you if you have a winning run? Do you forget that you've spent the last year working hard to get to a point where your trading is doing what you want? And because the money's coming in quick, does that impact you? Do you think that you don't necessarily deserve it? So there's all sorts of weird and wonderful things that go on, and it's not generic to each person. Yes, there are some positive money mindset attitudes that you can have. And yes, there are trading mindset specifics, but each trader will have different things going on. And I've had to deal with this myself, and it's still an ongoing process. I think relative to where you are and where you want to be, it's an ongoing process. But I think the key thing with mindset when it comes to beating the markets and being ahead of the markets is understand that you're going to spend time where you are ahead of the market in terms of your performance, but you're also going to have times where you're not ahead of the market. So the next thing is, I've touched on this already, is if you want to beat the markets, what particular strategy or process do you have in place that has the capacity to do that? So I will see traders trading far too many strategies at once. I will see traders going and focusing on day trading too soon. There's 1,000,001 different reasons, but very often that trader hasn't taken the time to acknowledge whether the particular strategy that they are trading actually has the capacity to beat the markets and deliver what they want. So this is why data and this is why testing is so important. Traders need to understand what is the worst case scenario for the strategy that they trade. So very often I'll say to a trader, look, if you trade 3 of our particular strategies over the period of 5 years, this is what the average result is. And we'll break it down to yearly, 6 month, and even quarterly. But what that trader has to understand is they may come in and start trading that strategy at a period where it's underperforming. It's going through a losing patch. So they're aiming to beat the market, and very suddenly they go underwater. And then they think, well, this isn't going to work. I'm not going to be able to beat the market this way. Whereas actually all they're doing is they've managed to come in just as they're hitting a drawdown period. Then they walk away. Then the strategy starts to work. They can see it outperforming the market or outperforming their expectation. And then what happens is they think, right, I'm missing out now. And they get in, and then it goes through a tiny little drawdown period. So they are on what I call the wrong side of that strategy in 2 occasions because they're thinking too short term. So this is so important to understand that you have to. If you want to beat the market, you've got to have a strategy that has the capacity to do it, but you've also got to have a longer term thinking. Good. So that is all I've got for you today. I will be back with you again very soon.